All right, today we are diving into a theory that completely turned corporate finance on its head. It was cooked up back in the 1950s by two economists, Franco Modigliani and Merton Miller, and it all boils down to one simple but incredibly powerful question. So let's just get right to it. Does the way a company slices up its financial pie, how much it owns versus how much it borrows, does that actually change the size of the whole pie? I mean, this was the billion-dollar puzzle that experts in finance argued about for decades. To really get it, though, we first need to understand the two main ingredients in that pie. So on one side, you've got equity. This is the piece of the company owned by shareholders, the owners. It's definitely higher risk, but hey, it also comes with the chance for much higher rewards if the company knocks it out of the park. And on the other side, you've got debt. Pretty straightforward. It's money loaned to the company that it absolutely has to pay back, with interest. This mix of the two is what we call a company's capital structure. Now, for the longest time, the common thinking was that you could find some kind of magic recipe, a smarter capital structure that would somehow make the company's total value just grow. For example, a lot of people thought that taking on a little bit of debt was probably a good thing for shareholders, but nobody could agree on how much was the perfect amount. It was all a bit of a mystery. With then, these two economists came along and just blew that whole idea to bits. In the 1950s, Modigliani and Miller challenged this old way of thinking with a revolutionary theory that, honestly, at first seemed to go against all common sense. They called it the capital structure irrelevance proposition, and what it said was this: in a perfect world, the value of a company has nothing to do with how it's financed. It's all about what the company actually does, the money it makes from its assets, and its day-to-day business. Now, to make this pretty radical idea easier to swallow, they used a really simple analogy. Think of a company's total value as a pizza. Modigliani and Miller basically argued that the size of that pizza is all about the quality of its ingredients and how well it's cooked, or in business terms, the company's real assets and its business strategy. And this just nails the idea perfectly. It doesn't matter if you cut that pizza into 4 slices or 6 or 8. Slicing it differently doesn't magically create more pizza, right? The total amount is always the same. In the same way, just dividing a company's value between people who own stock and people who loaned it money doesn't change what the company is actually worth. But, and this is a huge but, this whole idea only works in a so-called perfect world, which is a theoretical concept we need to break down right now. So what in the world does this perfect world look like? Well, this slide shows you the completely ideal, frictionless conditions for their theory to be true. No taxes, which means debt doesn't get its main real-world superpower. No bankruptcy costs, meaning a company could take on insane amounts of debt with no real downside. It's basically an academic sandbox, right? It was designed to isolate one single variable to prove their core point, that financing decisions all by themselves don't create value. But of course, we don't live there. So what happens when we step out of that sandbox and introduce a very, very real complication? Taxes. Modigliani and Miller knew their perfect world theory needed a reality check, and this is where debt suddenly becomes really, really interesting. This is where they introduce the idea of the tax shield. See, in most countries, the interest a company pays on its debt can be deducted from its earnings before it calculates its taxes. This means that borrowing money literally shields some of a company's profits from the government, and that creates real, tangible value that goes back to its investors. Let's make this crystal clear. Imagine two identical companies, both earning $100. Company A on the left has 0 debt, so it pays taxes on the full 100. At a 30% tax rate, that's a $30 tax bill. Simple enough. Now look at Company B. It also earns $100, but it pays $20 in interest on its debt. That $20 is deductible, so its taxable income drops to $80. Its tax bill is now only $24. That $6 difference is real cash that stays with the company's investors instead of going to the government, all because of debt. So this led them to their revised theory. In a world with taxes, the value of a company that has debt, what we call a leveraged firm, is actually higher than an identical firm with no debt. And how much higher is it? Exactly the value of that tax shield. So it turns out debt can add value. But that brings up a new question, doesn't it? Should companies just pile on as much debt as they possibly can? Well, not so fast. This is where we land on the modern way of thinking about this whole thing. It's a trade-off. It's a double-edged sword. On one hand, yes, debt gives you that super valuable tax shield. But on the other hand, the more money you borrow, the higher your risk of what's called financial distress. That's when a company starts struggling to make its interest payments. And if things get really bad, it can lead to bankruptcy, which brings its own massive costs, legal fees, chaos that just destroy value. And this balancing act is exactly what M&M's work ultimately gave us. It's the foundation of what we now call the trade-off theory. The goal for any modern company isn't to just avoid debt or to maximize it either. The goal is to find that sweet spot, that optimal point where the benefits you get from the tax shield just start to be outweighed by the rising risks of financial trouble. It's a huge strategic balancing act. So when you boil it all down, what's the big takeaway? The ultimate lesson from Modigliani and Miller is that even though your financial structure matters because of real-world stuff like taxes, it's not where the magic happens. The true driver of a company's value is, and always will be, how good its actual business is, how well it runs its operations, and how much profit it can squeeze out of its assets. Which leaves us with this final thought. Modigliani and Miller showed us that how you slice the pie isn't nearly as important as the quality of the pie itself. So if financing is just a tool in the toolbox, then the real challenge isn't just about shuffling debt and equity around. It's about building a business that's worth financing in the first place. And that is the core question their theory forces every single leader and investor to answer.